Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls from their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Good morning, everyone. Welcome to the October 23rd opening playbook. We have kind of a special session planned this morning. Going to be talking about Social Security and government shutdown, impacts of what's going on the government and the stock market. And we have our illustrious two leaders here with us, Nathan and Graham. How you guys doing this morning?
Doing awesome.
Wow, the enthusiasm.
Hello.
Overwhelming.
I'm currently actually. I'm just curious. I need your.
I was gonna say the same to you, Dave.
I did a trade. I've been doing a little trade calendar spread on the SPY SPX, selling short dated, buying a long dated call, and the SPX options move overnight, so I can actually see how far they're up or down. It was actually above my profit target at about 7 a.m. this morning, but in Thinkorswim, it won't fill. There's no orders going on until market open. So now I'm down 7%. When I was up 22% at 7 a.m. Now I know someone here. I think it was Dave T. Is that right?
Yeah, it was Dave.
It was TradeStation, right? That will use SPX around the clock.
It was Interactive Brokers.
Interactive Brokers. Nate, did you ever get that working on your end?
I did. I set up the account and went through the whole process of doing it. I still have the account open, but I hated the platform so much that I couldn't do it. I mean, I built out a couple ideas with Interactive Brokers. But the other thing is their fees were about double what I'm paying with Schwab. And when I talked to them, they told me if I traded 1 million contracts a month, I could get lower fees.
Wow.
So I said, well, I'm probably not going to
trade in 1 million, right?
Yeah. So I just said, all right, let's go, baby. Yeah, that is where I left it with Interactive Brokers.
Gotcha.
I will say the mobile app's a lot easier to trade on, but like trying to use a desktop and set up what I was going for was brutal. But Dave and a lot of the Canadians I know have figured it out, gone through the process, and they definitely do fill outside of normal hours. That part is real.
I wonder why they seem to have exclusive rights to that.
Yeah, I don't know.
Maybe they don't, but
yeah, I don't know if it's like regulatory or
are there
what.
any other? Does anyone know? Are there any other platforms that will fill SPX or XSP in the post-market or pre-market hours? I'm just curious because, I mean, I'm sure it looks like my trade's going to hit now with the markets because it's a calendar spread, so I kind of need it in a range here, but it looks pretty good now. But I would have loved to have been out at 7 a.m. and not even have to worry about the market open.
I'm a little less concerned with the specifics of that and a little more concerned with why I'm the only Dave that seems to not know things you guys don't know.
Yeah, we've got secret Daves all over the place with information. That's true. Speaking of which, I didn't even look at
Wayne
Beyond
says
Meat
Trade
today.
Station. Wayne, can you do SPX at like 4 a.m. on Trade Station?
Yeah, we're
Beyond
not
Meat
talking
taking
15 minutes.
A little hit here. Down 18%, but that's like a nothing move for Beyond Meat at this point. 18% is like break even. By the way, speaking of hitting targets, hit our overnight option target, which is nice. Good job, everyone there. Always good to get a bounce back after a ugly red day first thing in the morning. So glad to have that. And then we talked about earnings. Graham, earnings yesterday were super boring. I don't know if you saw it. Like,
Yeah.
I posted like the 3 biggest ones that I was looking at, and they all were very small moves, which is not exactly what I was expecting when things seem pretty chaotic right now, to have like a very quiet, boring earnings day. But I guess that's what we get. So I'm interested to see if we get some delayed follow through there on some of these different tickers. But yeah, overall, pretty quiet actually after hours.
Yeah, it is. And it's I mean, it's overall a good day in the stock market. Green is good.
Green is good. We'll take it. All right. Let's I think
I just checked.
sharing.
Fear is still high. We're at 29 on the fear and greed gauge.
Yes, and that is in part why we're taking a little sidestep to talk about this today. This is one of those topics that come up on a semi-regular basis for our members. Social Security, what that means, is there a risk? What does that look like? And just based on some of the kind of feedback we've gotten and things like that, it seemed like not everyone kind of has a good framework for how this could all shake out, and if there's a risk, and if it has anything to do with the government shutdown and all those sorts of questions. And so I wanted to just kind of take us a little bit here through what the situation actually is, what it looks like, why things are happening that are going on, and then some ideas of what you could do about that, including one trade actually that I quite like right now, and I'll take it at the end here. It's kind of similar to the Tesla trade that I gave at the roundtable. In other words, it's not necessarily that I have the highest conviction in this one particular trade. It's that I think the risk to reward is so overwhelmingly favorable that it makes sense to have in your basket. So that's really my approach here on the one that I'm gonna give you. And so we'll talk about that at the end. Before we get started, I would love to know, just from the people in here, the 500 or so folks that show up consistently to opening Playbook, how many of you guys are in the situation where Social Security either matters to you right now, is going to matter to you very soon, that you would have major concerns if there is a systemic break in Social Security? How many of you really don't care or have zero concern? Would just love to know kind of where everyone falls across that spectrum before we get rolling here. And then I'm going to dive in, like I said, just kind of cover a little bit of an overview of I think where we're at, and then some potential outcomes from there. And let me just pull up my chat so that I can actually see when people are responding.
A lot of yeses, a lot of absolute
Okay.
matters, a lot
Yeah.
of concern.
Okay.
Fed worker not getting paid.
Yeah, that's a whole different animal.
That's-
If you're on that side, Deborah said 15 years. Have it now within 5 years. Okay. All right. So again, here's kind of our topic for the day. So obviously, the government shutdown seems to have shown a bright light on all of the broken things in Washington, D.C., beyond just the current, budget and everything that's going on there. Not least of which I would say is Social Security. I feel like I've seen, more headlines and more concerns about Social Security in the light of this, even though they're not really directly connected, just because it seems like a time to kind of pause and be concerned with, everything broken in our government. Now, this is a program that everyone knows is fundamentally insolvent. In other words, it fundamentally is running out. And yet, over 73 million Americans receive benefits every month from the Social Security Fund, which is just a remarkable number if you stop and think about how massive the scale there is. So let's try to answer some real questions about the current status of Social Security and what it means for real people. That is my goal. We'll try to avoid the hyperbolic headlines and claims and stick to what the data shows. So we'll try, this is not for me today to kind of scare you and say any extreme statements in one direction or the other. I've seen a lot of headlines like this and the other, the Trump administration plans to covertly cut Social Security benefits. And then the article says they're arbitrary and cruel efforts, just flipping a coin to screw people over. And then, later goes on to say that 30,000 people died while waiting decisions, which of course I'm sure is a true data point, but almost making it seem like, hey, they died because they didn't get their benefit in time. They starved to death or whatever the case may be. And so while I'm sure many people in here have very strong opinions on the political side, we'll talk about that in a little bit, have kind of go one direction or the other on this. Today, we're going to try to avoid like assigning, hey, they have cruel, arbitrary intentions here, and just say like, hey, where are we at? Where is the data pointing? So with that, let's talk about what actually broke Social Security. Well, I'm sure half of us would like to point at one political party while the other half was pointing the other direction. Government incompetence is only actually a small part of the Social Security story. And you might want to take a snapshot here of this, because this might be the only time that I let government incompetence off the hook here and say that it's a relatively small part of the picture. But in reality, it really is a small piece of what's actually going on with Social Security. In reality, it's our modern standard of living, economic, and cultural structure that has broken Social Security. In the 1940s, like right at 1940, when Social Security was introduced, there were 159 workers paying per one person collecting benefits. So for every one person who was getting a check, there were literally 159 people working to benefit them. The average worker in 1940 lived to just under 65. I think it was like 64.2 when I looked at it, right? So obviously, you weren't in the same situation that we're in now relative to, how long people live. Now, by 1945, just 5 years later, because of the way this was phased in, and just a small increase in lifespan, the ratio moved. Again, we were at 159 down to 42 workers per beneficiary. Okay. So that's a pretty drastic move in just 5 years. By 1960, it collapsed to just 5 workers for every one person collecting benefits. All right. And today it's right about 2.5. I think someone said their best guess was 2.65 to 1, but right around 2.5 and heading in that direction. 2.5 people working for every one person collecting benefits. So the combination of a lower birth rate, which obviously, trends the opposite direction in terms of retirees to new workers, and a longer lifespan has created a dramatic imbalance that we can't magically solve with a good idea from Congress. So again, this might be the only time I let Congress off the hook, but I am mostly letting them off the hook here in terms of the fundamentals of Social Security. Don't worry on the birth rate. I'm doing my part in case you guys were worried. I've got it down on my part, helping remove the workforce for Social Security. Okay. But just to summarize those ratios, you can think about it like this in kind of the practical terms. If Joe lives a long life in the early 40s, he could retire at 65 and live to 75. So what he would be doing is he would be getting benefits for 10 years, and there would be about 50 workers, contributions all combined to support him from 1945 to 1955. You just take the average of how many workers there were. It would basically be, 50 workers over the course of 10 years. Now, if Mary lives a long life in the modern U.S., she could retire at 65 and live to 95. Now, of course, she could live longer, but just kind of an average long life, she'd get the benefit for 30 years, and there would be about 2.5 workers combined to support her. All right, so that's kind of, if you just break it down on a single use case, the dramatic shift. Joe is going to have 10 years of benefits with 50 times the people, or 50 people for each year. Mary's going to have 3 times as long with 1/25th the amount of work supporting. So I say all that to say this. Social Security wasn't just mismanaged for a few years, and all we need is the right politician to fix it. It's fundamentally broken because of the actual, the structure that Social Security is built on has been fundamentally broken. So when does the money run out, and what actually happens when it does? Well, with the extreme ratios I just showed you, you might be wondering, well, how isn't Social Security already blown up well before now, right? Because, if you look at the 159 to 1 down to the 2.5 to 1 plus the cost of living and everything tied to that, it kind of makes you think, oh my goodness, how is it already not blown up in massive fashion well before now? Well, really, this is in large part, very large part, due to the wealth of the U.S. since the 40s. So while the ratio of collectors versus workers has gone parabolic, 159 all the way down to 2.5, negatively parabolic, so has the wealth of our country. So it's gone parabolic in the other direction. Here's the trifecta that they've used to make up the gap. Incomes have gone up dramatically. So they went from $956 in 1940, that was the average annual income, about $22,000 for inflation adjusted, to about $62,000 in 2025. Now notice, that's a great increase, right? That's about 3x increase. It certainly is not the increase that we should see based on the wealth of the U.S. So the average worker has gone up 300% in the last 80 years, which is, good by most international standards. But obviously, it's still massively lacking behind this massive parabolic chart of wealth. And so it certainly shows you that the average worker has not participated to the same level. And we could go back and forth on all the reasons why. I have my own ideas about that. But for now, just know that, yes, incomes have gone up dramatically, even by any kind of arbitrary, or not arbitrary, but like objective inflation standard. The taxable limit for Social Security has also gone up dramatically. Okay, so you have incomes that have gone up, and then the taxable portion of the income gone up as well. So it's gone up from $3,000 in 1940. That was the taxable portion, which would be $69,000 inflation adjusted, to $186,000 in 2025. Okay, so that's close to triple, 2.5, whatever that ratio is of the taxable portion. And then the percentage applied, like actual percentage applied to what you're taxing, that amount has increased too. It was 1% when they introduced it. Now it's up to 6.2%. So when you raise the limit by nearly 3x of what you're actually taxed, that's inflation adjusted, and then you increase the percentage on that limit by about 6 times, what you're doing in net effect by kind of increasing both those numbers, which is a great government trick to kind of not make it seem as extreme, you increase 2 factors at different times that are multiplied together. What you end up is collecting about 18 times the relative income compared to the original concept. So if you're wondering, okay, based on those extreme ratios of going from 159 workers to support one person down to 2.5, how could we possibly not have already completely blown this thing up? Well, it's because you're actually collecting about 18 times the relative income over that same period. Okay, so back to this. So when does the money run out, and what happens when it does? Keith, yeah, great point. Keith said you double that percentage if you're self-employed, which a lot of people are, so they're paying their cap. A lot of self-employed people who happen to have higher incomes are also paying that cap twice. So that cap that has gone from 186, or has gone up to 186,000, then you multiply it by 2. So a couple things to note here, and maybe to dispel some of the more extreme headlines and things out there. Social Security is not going to go bust and stop, even if they don't figure out ways to kick the can down the road, but they will likely figure out ways to kick the can down the road. Okay, so even if they don't, Social Security doesn't just literally stop kicking in and no payments going out. That's not how it works. But more than likely, it won't come to that anyway, because they should and most likely will figure out ways to kick the can down the road. So again, here's how it works, just to dispel any rumors and crazy headlines out there. When the actual Social Security fund runs out, i.e. the excess that they have right now that they've collected over the years, which was meant to be a massive excess, when that runs out by law, Social Security flips to a pay-as-you-go system. So in reality, you hear a lot of people say, hey, Social Security is going to run out. No one in their youth will ever collect any Social Security. Well, actually, if it goes to a pay-as-you-go system and they don't change the laws, really everyone would collect forever as long as Social Security is a thing. It would just be that it would be reduced to a pay-as-you-go. So it's not like it would go down and the fund will go down, and they pay the rest they could to the last remaining years, and then boom, it will go away and no one would ever collect again. Actually, it would kind of go down at once, and then everyone would collect based on what's available. So what that means, that pay-as-you-go, is that the Social Security Administration is only able and legally allowed to pay benefits from what is currently collected in real time. So legally right now, Social Security can't borrow from general tax funds. They can't go get money anywhere else in our current law. They're legally only allowed to pay from the Social Security fund. And so the pay-as-you-go system, what that would mean is they would look, okay, how much money do we collect this month? Let's zero it out and pay everything we have, and then wait until we collect money next month and pay that out. And that's how it would be in the current structure. As of now, that projected date is in the early 2030s. Okay, so if we run out and we get to zero in the early 2030s, and we were in a pay-as-you-go system, the estimates are that we would have enough to pay about 77% of the benefits. Okay, so that's kind of what the projections are right now. Imagine that next week, the government made an announcement, hey guys, we thought it was going to be the 30s. Actually, it's today. We have no excess money in the Social Security fund, so we can only pay exactly what we bring in. Their estimates are that we would then be able to pay 77% of the benefits. So that kind of outlines our worst case scenario, for Social Security. If nothing happens in the next, let's say, 8 years, what would happen is that most retirees would collect their normal Social Security, and then kind of overnight, it would drop by 20 to 30%. So that's kind of your worst case outline. We know that we have some excess to cover all of the benefits, for 7 years, 8 years, 9 years, whoever's projection you want to believe in. And those would pay because they're legally required to pay. And then if it did hit zero, that would kind of be like shrinking the fund. And then someday, some actual practical day, it would run out. It would hit zero. And then overnight, it would switch to that pay-as-you-go system. And our projections are that would be about 77% of the benefits. Now, more than likely, it won't get to that point, if for no other reason, because no political party wants to be at the helm when that bomb drops, and they would pretty much do anything to avoid it. Eric's asked, what about the money held? Yes, the money that they collect is put into special interest bonds. So it's not just sitting there in a bank account. It is put into things that should have some yield. Now, of course, we could go back and say, man, the government really should have put it in the S&P. If the government put every Social Security dollar ever collected in the S&P, they'd have $1 trillion surplus that would last decades and decades and generations by using true compounding interest. Because if you think about it, they have the biggest float opportunity ever, right? They collect money from you from the time you're 18 to the time you're 65, and they don't have to pay any of it out until that retirement age. And so from the early income collected, they have a 40 plus year float. And their hybrid float is like 30 plus years of money they could collect, and they don't have to pay out. So if you want to point the finger at mismanagement, you could certainly do that. You could say, hey, the government should have just put it in the SPY and then waited. But of course, most of us haven't done that either, right? How many of you started when you were 18 and put money in the SPY and let it compound, and now you have wealth beyond measure because you've compounded it? Most of us haven't done that either, right? And so the government, I think, again, pretty hard to point the finger at them. They did what they thought was smart, and they put it in guaranteed special interest funds. And if those ratios would have held up, they would have been fine, frankly. So again, just being fair to the government for once.
But imagine if they did put it in the SPY, what a phenomenon that would be. The government pumping our stuff.
Oh, they should have. Imagine if like 20 years ago, they just said, hey, we've got, 300 billion left. It's all going to the SPY tomorrow. Yeah. What a day that would be. Charles, the pay-as-you-go system is not dependent on what you pay as an individual. It's based on what they collect. So they're still paying benefits to everyone, all 73 million people who are due benefits. They're still paying all of them, but they're only paying based on what they collect. So it's a pay-as-you-go based on what they collect, not based on what individuals are paying. So here are the things that you will likely see floated before then. And when I say before then, I mean before we get to that kind of catastrophic moment of things running out. You will likely see increase the SS, Social Security taxable cap. Now, this happens automatically every year. The Social Security tax cap is going up. It went from 166 to 177 or something from 2024 to 2025, something like that. So it's already going up. But what they could do is they could kind of push for that leap, right? They could kind of go for the the rich doesn't pay their fair share kind of approach and say, listen, we need to forget it going up, gradually. It needs to be $10 million so that the Musks and the Buffetts and everyone else, can pay an outsized amount of Social Security, and therefore it creates an outsized increase to the fund. So that's one thing you'll probably see floated. Another thing you'll probably see is to increase the full retirement age with a very slow rollout. Obviously, this is proposed all the time. The increase of the age is talked about, I think, every political cycle. And if they do that, it would likely be a very slow rollout. The last rollout phased in over 22 years. So that's one thing that you'll probably see floated continually as well. Another thing that you'll see very likely, this is probably one of the more likely ones, is cost of living adjustments and payments subject. The cost of living adjustments, there's an acronym, it's like CULA or something. I forget exactly what it is. But basically what that does is it says, hey, the requirements that we have to pay benefits are somewhat dependent on the cost of living adjustments, how much we owe based on inflationary metrics and things like that. So one of the things that the government loves to do is just change the metrics. Hey, we'll change our meat price per ounce inflation from a T-bone steak to a pound of ground beef, and therefore the number goes down, and therefore the payout goes down. And the kicker there is relatively small, right? It's like, some $489 payment goes from $489 to $473. And, that $16 that someone is definitely annoyed about doesn't completely change their life. But when you multiply that by 73 million payments, it makes a big, big difference in that fund and how quickly that fund gets reduced. So that's one of the things that, will very likely be floated. And then payment schedules, pushing those out 4 days here, 6 days here, all that sort of stuff that just increases the float. Anything they can do kind of between the lines there is likely another thing that you'll see to delay that kind of 2033, 2034 date. Another thing that you might see is disqualify wealthy earners from receiving any Social Security benefit. This is one of those classic political arguments. Some people will say, why is someone who's, a multimillionaire or even a billionaire collecting Social Security? That's outrageous. They don't need it. It should certainly go to the people who need the benefit. Other people will say, well, listen, Social Security is literally a pay-in, pay-out structure. You are literally receiving the money you paid in. It's not like a typical government benefit that's from a general fund that gets paid out. This is a situation where you pay dollars out of your paycheck. It is your money. So taking it and making people ineligible for it would be illogical from that standpoint. And there's lots of discourse in between, but it'll certainly get floated. It'll certainly be a conversation of whether that comes into play, and it kind of takes the top couple percent of people who are collecting Social Security and then spreads it out on the other 98% to make it a little more justifiable for the next coming years. And of course, the most likely outcome is some combination of those ideas like we got in 1983 with the Greenspan Commission. So you create this bipartisan commission. You basically say, by the way, the reason they do the commission is kind of funny. Basically what they say is, listen, our party might be in position right now, and a different party might be there in 2 years or 4 years. Neither one of us really wants to be responsible for, hey, we're cutting Social Security, we're increasing the age, we're doing X, Y, we're doing Z. So let's create this bipartisan commission, and then everyone can just blame the commission for all the decisions that get made. So it's kind of a fun political strategy that they'll often use in situations like that, where you'll likely see a commission get formed, and the Republicans can say, listen, it's not us, it's that stupid commission that made those decisions. And the Democrats can say, listen, it's not us, it's that stupid commission that made those decisions. And what they'll likely do with one of those commissions is do some combination of factors, the cost of living adjustment, certain streamlining of who can get access to those benefits and all that kind of stuff. And what they'll try to do is kick the can down the road. So with that being said, and guys, hopefully this is helpful just to kind of take a more of a fact-based structure, because I know, like I said, there's been a lot of extreme headlines and ideas out there, and I know this does affect a lot of people. So it's not a typical opening playbook session, but I thought let's just take a moment, step back, go through the situation, where we find ourselves, and through kind of the data and the facts. So I hope this is helpful. If not, we'll get back to our typically scheduled programming tomorrow into the strategies and things like that. But let's summarize what we've covered so far. So yes, number one, Social Security is fundamentally broken, and it will run out fairly quickly at its current consumption. 8 to 10 years is the general expectation there. No, it's not as simple as some dumb politician mismanaging it. The foundational components of the U.S. culture, society, economics that it was built on have definitely fundamentally changed. Okay, yes, the dumb politicians could have done a little better job or a lot better job. That part's true, but it's not the fundamental breakpoint in Social Security. And anyone who just willy-nilly blames politicians on one side or the other is not really giving a fair assessment to what's gone on with Social Security in the last 80 years. Summarizing the worst case scenario, nothing happens and Social Security runs out. It would switch to a pay-as-you-go system, and the benefits would drop 20 to 30% essentially overnight whenever that fund hits zero. Okay, so that's what we would call our worst case scenario. What's the best case scenario? Well, the best case scenario is the economy strengthens, supporting Social Security for longer, and everyone has lots of kids like me, and we fix the ratio, and there's lots of more workers. Okay, I'm joking. Well, at least I'm mostly joking. I actually personally don't think that's a terrible worst case scenario or terrible best case scenario, but really, the real best case scenario is that many, many more Americans' wages are increased dramatically. We have a middle-class resurgence that fuels revenues while less and less Americans become reliant on benefits. So this is what I would consider the real best case scenario, where we have a true middle-class resurgence. Wages go up really across the board. This, by the way, is more important for Social Security than virtually any other tax or situation because Social Security is capped. Okay? So Social Security is capped, which means the wealthy getting wealthier and having some of those trickle-down effects in other areas do not necessarily impact Social Security to the same degree because Social Security is capped. So Elon Musk is not going to pay Social Security on $50 billion of new income. He's going to pay it on 180 grand. So his outsized earnings cannot blend in. So in other economic situations where, Elon Musk being worth $1 trillion will have an outsized impact. You could look at all kinds of them, income tax, capital gains tax, just simply the fact that he built the company and the dividends and the ROI that pays so many funds that are invested in Tesla, and the same thing with Google and all these other companies. You can really make a great case for how that top line, even though it's still dramatically disproportionate, pays out, across the rest of the economic landscape. That really doesn't happen in Social Security. So what needs to happen with Social Security is that we need to have a massive resurgence of lots of people who are having a increase in wages, massively increasing the revenues that are happening in Social Security. And at the same time, what hopefully will happen is that more and more Americans will become less reliant on benefits. So that if those two things happen at the same time, then we'll have a very healthy Social Security. Well, actually, it actually could happen very quickly. If you run the numbers on it, wages going up and some percentage of people becoming less reliant on benefits, that could flip Social Security actually incredibly quickly. It's kind of amazing. So that's probably what I would consider the real best case scenario. Now, the most likely scenario is that Congress or Joint Commission pass some combination of quote unquote solutions to kick the can down the road for a few more decades. Okay, so that's what I would consider the most likely scenario. Joint Commission, hey, we're going to let Social Security dip into this fund for 2 years. We're going to roll out a 68.5 retirement age over the next 20 years. We're going to make a certain percentage of people ineligible, some combination thereof. And then that makes it solvent for the next, 25 years. So obviously, then the question is, what actions do we take? Well, if you're convinced of the worst case scenario, then you probably want to be short the silver economy. The silver economy is kind of the name for the senior plus of where you would expect, their spending to be focused. Companies that have a huge percentage of their income relying on senior spending, especially discretionary spending, would of course take a massive hit. Right? So if we actually got to that quote unquote worst case scenario and seniors lost 25% of their income overnight, well, then you're going to have those areas, what we call the silver economy, take a big hit. Companies like QRTEA. Anyone know what that stock is? Let me know if you guys know what QRTEA. Here's a hint. They report that the vast majority, it's like 80% of their income is from age 65 plus consumers. That's your hint on what QRTEA is. It's a stock, but what the actual company is, they're the owners of the Home Shopping Network and QVC. And so if seniors immediately overnight lost 25% of their income, you would expect, QVC, HSN to take a massive hit on their business. And so that would be a company that you want to short in that situation. We would also expect healthcare stocks to take a hit if seniors tighten down on all possible expenses. That's your AbbVies and things like that. That would likely take a huge hit in this expectation. But there's one trade idea, if you're not planning on the worst case scenario, you're just kind of planning on all scenarios, that I think is really interesting, and that's actually TLT. So TLT is a 20-year bond, and I think it's a really interesting trade that accounts for really several different scenarios and combinations thereof. Remember, I'm not trading for the worst case scenario. I don't think that's very likely. If you wanted to do it, you could get positions starting in the next couple of years that were short on some of those high senior spending areas. That's not really what I expect. Here's why I think the Fed 20-year bond, the TLT, is in an interesting position right now. So the Fed cut cycle is underway, with most people expecting cuts all the way through 2027. When we cut rates gradually from 2.5% in January 2019 to 0.25% in March of 2020. And when I say gradually, I don't mean slowly, because those were actually relatively quick. I just mean a series of cuts happening over the course, of a year and a half. TLT ripped from 120 to over 180, which is a monster move in TLT. I mean, TLT does not move 50%. So that was an absolutely massive move that happened right during that cut cycle. Number two, there's also a huge amount of short interest piling up in the bond market. Okay, so that's a huge part of the equation. Oops, let me go back. If we break through to the upside, it could flip on the turbochargers there with short interest. So if you've got these funds and people who have billions of short interest and the bond market starts to rip, they're not going to be able to stay in those short positions. They're going to have to buy shares back at higher prices. And that would add rocket fuel to an increasing TLT or other bond instrument. Number three, the U.S. is still relatively healthy. And I put relatively there in quotes. Don't beat me up in the chat too much for this one. By relative, I mean to the rest of the world. If because the U.S. actually is still a pretty attractive safe haven by comparison. And if we get shockwaves, bonds could benefit substantially. Okay, so if we get international shockwaves, which I think that we've seen some and we'll continue to see some, believe it or not, the U.S. is still a pretty attractive safe haven relative to the other options there. And so that is one of the reasons that I think we could see bonds be healthier, even when the U.S. economy maybe doesn't look as healthy, is because relatively, internationally speaking, it still looks pretty compelling. Number 4, we could see more surpluses. So we had that first surplus in 20 plus years. And if we get more of those, it could help solidify that the long-term stability of the U.S. is actually in good shape. Okay. So that's one of the things that we could see. Hey, good surpluses. Look, the U.S., we're doing better. We're cutting costs. We're getting healthier. And that would make the bond market far more attractive. And number 5, and by the way, this is the most important one here on all of the equations of why I think the risk reward makes sense. TLT is trading 100% off its highs. Okay, that means if TLT went back to its highs, it would have to go up 100% to get back to all-time highs. There's a ton of potential purely from a risk-reward standpoint, and an acute shock, something like Social Security, would typically trigger a flight to safety. So what happened if we got a big flight to safety? We'd probably see bonds shoot up, right? And then some of that short interest would trigger, and all that kind of stuff would pile up, and we could see TLT absolutely rip if the conditions were right. So here's a catastrophe, like a shockwave that moved, or a healthy trade. It's actually the same trade. It accounts for an acute risk situation that moves a big amount of money over to a flight to safety that triggers, moves it higher, or literally we just get healthier year over year over the next couple of years as we do rate cuts, hopefully show a few surpluses, and we get a healthying bond market over the next 2 years. So this would be the trade, and it's a pretty dramatic trade. It would be to buy to open the January 2028. Yes, 2028. That's not a typo. 2028 130 call. Sell to open the January 2028 135 call. The debit there should be about 15 cents. If this trade were to hit, it would be about a 3,000 plus % ROI potential. I think like 3,300%. So like I mentioned at the beginning, what I'm going to give you today is not exactly a high conviction, high probability trade. This is more like a catastrophe trade where if we got one of those shock waves and saw TLT rip, short interest cash in, and the market go parabolic on TLT, or if we actually just got really healthy in the next 2 years, which might be a long shot, but still a shot nonetheless, this is one of those crazy risk-reward scenarios that you could have included in your long-term position. So this is on TLT. I'll pull up the broker here in a second, but let me, I'll go ahead and copy this in there for you into the chat. And I will add the ticker in here before I pull it up. And then we will go ahead and move over to the broker. Yeah, Uber Leap, someone said. By the way, I'm seeing a lot of chatter in the chat about whether government employees are paying Social Security or not. I don't know if the best place to have that conversation is in the chat because you're probably going to get a whole bunch of mixed results from different people in different situations. I think you could research it and probably find that there are a couple scenarios that you do not pay Social Security, but in most situations, everyone who collects a paycheck is including government employees. So you guys can do that research and report back, but I'm pretty sure there are only a couple use cases where people pay into a different program instead of Social Security. All right, let me move over to my brokerage account and we will pull up TLT. Okay. Got to share the right screen here. Bear with me. Okay. Here is TLT. I'm on the 15-minute chart, which isn't going to tell you a whole lot. Let's go to the weekly chart. Let me back this up here. We'll go back a bit. There you go. So here's TLT. You can see how ugly it looks all the way down. Like I said, high of 179, low of 82, about 100% off the highs right now as we sit at $91. Here was the run I was referencing when we went pretty parabolic during the aggressive rate cut cycle from 2019 into 2020. You can see how quickly that went up. And here, obviously, is where we are now with a continuing decline and really no big move up, even from the rate cycle. I mean, we've had a couple bounces, but nothing significant. So the question is, does this look like a good trade? My answer is no, it doesn't look like a good trade. And I'm not taking it as a high conviction momentum trade by any means. So please, if you're looking for something that you really want to count on to hit, this would not be the trade that I would recommend. What I think is that because TLT is so beaten down and there are enough factors that could actually move it in a positive direction, and then there's even some factors that could send it to hyperdrive, the idea of it getting back here into the middle, kind of between the highs and the lows, for a 30-to-1 risk-reward ratio makes sense to me. So it would not make sense at a 2-to-1 or a 5-to-1 or even a 10-to-1, but a 30-to-1 risk-reward ratio, I think makes a lot of sense here on TLT. So that's the trade. We're trading it kind of right here into this middle zone, and we're giving it, yes, not a typo, to January of 2028 to make that move. So here it is. Some of you guys must have already taken this. I hope you guys use limit orders because the mid price was about 11 cents when I popped it up before opening Playbook, and it's jumped up to 20 cents. And there's not a ton of open interest here, so I'm wondering if you guys are moving the needle here. There's a little more open interest, by the way, if you go down one strike. So if you go down to the 125, 130 there, a little more volume on that one. I'm going here to the 130, 135. And I am looking to take about $7,500 of risk here. If I hit it, it would turn into 242 grand. Now, do I expect to hit 242 grand? Do I think it's a high probability that I make $242,000 on the trade? Of course not, but it's a risk reward that makes sense to me given the factors that I'm interested in here. So it is, like I said, about a 30-to-1 risk reward, a little over, depending on exactly what price you get on. And you would go out. That's 820 days away. Mid price popping right back down to about 17 now. I'm going to start at 15 and see if I can get filled there on TLT. So I will let you know if I get filled on TLT. But that is the trade, kind of in my opinion, that encompasses. Could set up for that worst case shock scenario, but could also set up for even just a healthying, that's probably not a word, an economy that's getting healthier, some positive news during a rate cycle. By the way, thanks, for being here. Appreciate you guys listening to kind of a little bit of a different take on opening Playbook, going down a different avenue. I hope it was helpful to some of you. The last thing that I want to mention is that in this scenario that we find ourselves right now, where the market is getting volatile, we talked about, the VIX is still only 18, but the actual net movement of the market is increasing dramatically. I really like the two-way trades right now. I'm leaning on more two-way trades I think they're kind of a best case scenario with the VIX where it's at, but the net movement happening. And so if you're not a two-way options member, I do want to give you a chance to join two-way options. I think it's kind of a no-brainer from where we're at right now. So we'll play that here for you. Just hang tight for, right here in the same room. But yes, you guys could trade this for a different expiration. The reason I like the 2028 is because I think the rate cycles and the kind of the other side of a healthy like surplus economy could take several more years. And so I'm giving it as much time as I possibly can. Max risk is just whatever you pay for the trade. So I did 500 contracts at $7,500 of total risk. But if you did one contract, you'd be risking $15. If you did 10 contracts, you'd be risking $150. So just depends on what you paid.
Mandatory disclosure.
Sorry, how'd I get the 2028? I just went to the trade and scrolled down to show all expirations and went down for the most. So again, hope that's helpful, and stay tuned. If you guys have not been part of two-way options, highly recommend it. Again, I think these markets are pretty ideal for movement-based strategies, and this is one of my favorite one. And we've had a really nice hit rate, and I've been piling up some wins. So take advantage of this if you haven't already. Thanks, everyone.
This is mandatory and it's important. The profits and performance shown are not typical to any one individual subscriber. We make no future earnings claims and you may lose money. Every example you will see today was from live, real trade signals sent out in real time to traders just like you. No curve, fit, back test, no monkey business. Now, from July 2024 through January 2025, from the live trades, we've seen an 85% win rate. That is amazing right there. And this is on options, which is even harder to do, which is why I'm more impressed with this. Average winner of 42% and an average return of winners and losers combined 25.3% over a 7-day holding period in the live model. Wow, the numbers here are fantastic. But we can't guarantee any specific future results as there's always a high degree of risk involved in trading. See our terms on the Prosperity Pub homepage for more information. Now, let's be real. In trading, there will be losers. There is no black box miracle system that prints out winning trades automatically. And the whole purpose of Nate's research and work with traders is to help give you an edge in the markets. If you can't handle a losing trade, then you really shouldn't be trading with real money again. Losses in trading have occurred and will occur in the future. Hi, everybody. I'm Jack Carter. Thank you for being here today. You have arrived at an opportunistic time. Now, all week long, we've been asking folks a very simple question. Where will the stock market finish in 2025? Higher? Lower? Well, out of 2,740 of you that responded to this question, almost 80% said higher, around 20% said lower. Now, what about those in the webinar right now? Post your answer in the chat. Are we going to be higher at the end of the year or lower? You already know what I think. We're going to be higher. Now, maybe you have renewed hope in our government officials. Type in higher or lower. Maybe you're confident in AI to take us to the next level, or maybe just the opposite. You might be worried about a second wave of inflation that doesn't stop, like in the 70s, causing an incredibly painful next few years. Or maybe you're concerned